Good afternoon, everybody, and welcome to the first financing call for this winter. Really excited to have you all here. This is Sam Kramer, Program Director for NASEO. Really looking forward to the discussion today, and we're looking forward to getting started. So I'm going to pass the line to Dan Farrell to help us get kicked off today. Dan, are you there?
I'm here. Can you hear me?
We can.
Okay, great. Thank you, Sam. Welcome, everybody, to the NASEO Financing Committee call. Just want to take a quick minute here to thank my colleagues on the Financing Committee leadership team, including Jeff Pitkin, the co-chair of this committee, Robin Boyle from the State of Montana Energy Office, Eddie Trevino from the State of Texas Energy Office. We also have Sean Williamson from USDOE, Sandy Fazeli from NASEO, and our NASEO affiliate members, Matt Brown from the National Energy Investment Fund, and Tom Myers from Slipstream. So very quickly, thanks. I want to just do a couple of housekeeping items here. The agenda and materials for the call are available through NASEO's Financing Committee page, and that's naseo.org/committee-financing. Access everything on today's call by clicking on the link in the financing events sidebar to the right. Second housekeeping item is that all lines for this call are muted, but if you have a question, please enter it into the chat function or use the raise hand on your dashboard so we can unmute you when the time comes for discussion. So a little bit about today's agenda. We'll be turning our attention today toward new and innovative financing programs that are being developed to reach underserved customers, with special attention being paid to low to moderate income families. These customers can greatly benefit from clean energy financing, but often face increased barriers to financing energy improvements in renewable energy systems. Fortunately, organizations around the country are working on new and innovative approaches to ensure that LMI customers are able to access the benefits of energy efficiency and renewables through financing. So with that said, I'm going to pass it over to Jeff Pitkin to introduce our speakers.
Hi, Dan, can you hear me okay?
Sure can.
Okay, great. Good afternoon, all. It's Jeff Pitkin from NYSERDA in New York. As Dan mentioned, our speakers today are going to be touching on new initiatives that their organizations are pursuing to help LMI and other underserved communities for accessing energy efficiency and renewable energy improvements, as well as reviewing best practices in financing these from around the nation. We're going to hear from each speaker for about 15 to 20 minutes, and then we'll open the line for any questions and have a short discussion with time permitting. So our speakers on today's call are Melanie Santiago-Mosier, who's the Managing Director for Access and Equity Programs for Vote Solar, and also Bettina Berjou. I hope I'm not butchering that, Bettina. Bettina is a Green Finance Fellow with the Green Finance Center at NRDC, the Natural Resources Defense Council. So now I'll turn it over to our first presenter, Melanie, who's going to provide us with an update on her organization's work around LMI solar financing. Melanie, feel free to start whenever you're ready.
Thank you, Jeff, and thank you to you and Sam and Daniel and all of you for the opportunity today to talk about some of the work that we've been doing to investigate opportunities to unlock capital for underserved communities. So what I'm really going to focus on today is providing an overview of the Inclusive Solar Finance Framework report that we put together with Sustainable Capital Advisors. It provides a roadmap for addressing some of the financial barriers to solar that are currently faced by between 44 and 78 million low-income, low-credit, and low-income and low-credit score American households. This framework identifies specific policy and market-based financial solutions for expanding solar options for this significant and underserved segment of the U.S. energy consumers. Sam, next slide, please. While we're waiting for the slides to move, a quick introduction to Vote Solar. As Jeff said, my name is Melanie Santiago Mosier, and I'm the Managing Director for our Access and Equity Programs. Vote Solar is a national nonprofit organization, and we work to foster economic opportunity, promote energy security, and make solar a mainstream energy resource across the U.S. We provide a combination of deep technical and policy expertise to legislative and regulatory work across the nation. We work with industry, nonprofits, utilities, legislators, regulators, and other stakeholders to advance solar energy programs and policies that enable scale and equitable solar solutions. So as you can see on the slide in front of you, we have 5 programs that we work on. I'm the Managing Director for our Access and Equity Program. And I like to point out that we used to be called Low Income Solar Access, but as we as an organization are growing and evolving, we're really recognizing that we need to focus more on overall equity and not really just on low income solar access. So next slide, please. So why did we do this project? Well, solar has spread like wildfire in the last decade. Many customers have a variety of options available to access solar, from outright purchasing, leasing, power purchase agreements, utilizing PACE, community solar, and other methods. So today, a lot of consumers are no longer passive participants, but they're free to choose how and when and in what manner they transact in the evolving clean energy market. But this energy evolution hasn't been equally accessible to all consumers across the country. By and large, low-income customers have faced disproportionately greater obstacles in going towards solar projects and other clean energy projects that have the potential to produce much-needed economic benefits. And many of these barriers are financial, so the cost, credit restrictions, policy challenges, et cetera, collectively have the impact of limiting options available for more customers. So developing an inclusive solar market for everybody is essential. The inability for low income and low credit score neighbors to access solar energy endangers the ability of a low carbon revolution to deliver on the environmental and societal benefits that it promises. And second, across the country, we see that there are different charges, taxes, credits, and other mechanisms used to fund economics incentives for the adoption of new energy technologies. And when customers who pay into those sorts of funds can't access them, well, that creates some inequities and can have a destabilizing effect. Third, low income and low credit score customers represent a significant portion of the United States population. So in order to really allow markets to grow, we really have to find ways to make solar financing and clean energy financing more inclusive. And then finally, bringing the benefits of solar and clean energy to underserved communities is just the right thing to do. We have the potential to open up economic opportunities, health benefits, environmental benefits, and access to jobs for the communities that need it the most. So we worked with sustainable capital advisors to find ways to expand the universe of solar customers by looking at a major barrier facing these customers. And in fact, many of the solar providers who may wish to partner with them, the lack of access to financial products that will support their solar adoption. So the inclusive solar finance framework seeks to identify solutions to the issues that we've found. Additionally, Sustainable Capital Advisors was careful to include some observations from the field where we really hit home the fact that inclusive solar finance solutions need to be structured to meet the unique needs of customers and communities, and to require processes and outcomes that prioritize collaboration, transparency, consumer protections, and education. So Sam, next slide, please. The next slide that you're going to see is about a woman named, Susan Young, and her experience. This is Susan and her sons, Jason and Sean. They live in Bridgeport, Connecticut, and were able to go solar because of the Connecticut Green Bank's partnership with Posigen. Connecticut's electric rates are some of the highest in the country, and Susan's bills used to reach $500 a month in some months. After going solar under the Connecticut Solar for All program, she was so surprised by the amount of savings she was receiving, she actually had to call to make sure it was right, and it was. The Connecticut Green Bank provided a direct credit enhancement in the form of $5 million of subordinated debt to Posigen's Connecticut Lease Fund, as well as $3.5 million in working capital loans to address timing gaps associated with third-party tax equity financing. Additionally, the Connecticut Green Bank offers an enhanced production-based incentive. So because of those well-designed finance mechanisms, over 2,000 low-income verified families like the Youngs have been able to go solar in Connecticut, increasing solar penetration in low-income communities by nearly 200%. And additionally, the Connecticut programs have been successfully in spreading solar adoption across communities of color in the state as well. So I think this is a really exciting example of how well-crafted financing programs can have a huge impact. And we'll go on to the next slide and skip over a quote here. Great. So the inclusive solar finance framework focuses on interventions that impact customers in the low income and also low credit score categories. In 2016, over 35% of all US households qualified as low income. So that's over 43 million households. In 2016, the average credit score in the United States was 695, and nearly 30% of all customers in the country were in the bad or poor credit categories. So that tells us that there's a tremendous potential to provide access to financing for a large portion of our population that may have challenges reaching financing. In fact, the number of households that comprise the inclusive solar finance target customer group for which policy interventions or market interventions may be required range from 44 million to 78 million households. So next slide, please. Great. In the inclusive solar finance framework, we identified 12 separate access methods. So these are the primary financial methods by which residential consumers go solar. We grouped some of these access methods together under 4 bigger categories because it was clear that some of those 12 access methods bear some similarities. So first, under the cash group, this is really cut and dried, where customers acquire solar systems upfront without the need for financing through either grants or just upfront cash. Under the second group, customers acquire solar at their property through a long-term financial arrangement based largely on personal credit. So these methods are also grouped together because of the role that securitizations play in accessing long-term capital for solar financing. So for most of these access methods, the initial capital provider is generally not the long-term counterparty. So customers may enter into a financing arrangement with a capital provider who is likely to aggregate, package, and then sell a pool of loans to investors looking for larger groups and a diversified risk pool. The possible exception to that here is the tariff OnBill financing mechanism. Under community solar, customers acquire solar through a system that's installed remotely from their property, and customers might actually own a share in a community solar array, or they might subscribe to a share. And under passive participation, customers don't directly engage in the procurement of solar for their needs. This is where a building owner might go solar, and as a tenant, the tenant has that benefit, or through community choice aggregation, or simply through the utility procuring utility scale solar. Next slide, please. And thank you, Sam, if you want to go clicking through this really quick. Importantly, the inclusive solar finance framework goes into the different barriers that customers experience in accessing the different types of financing products available. So across these, you see that monetization of tax credits is a major barrier. Low-income families often don't have the type of tax appetite or tax liability to really take advantage of tax credits. We also see that insufficient consumer credit is a very common barrier to accessing different types of credit. And then there are some interesting things that we found as well. So for example, with PACE loans, there's a maximum borrowing capacity under a PACE loan. And so somebody who has a home without a lot of value may not necessarily be able to get a lot of value out of PACE. And then for programs like PACE or programs like community solar, there may not be enabling legislation, and that holds true for CCAs as well. So next slide, what do we do about it? Overcoming those key barriers to increasing access to solar will require policy and market interventions that are deliberate and thoughtful in their design and implementation. Through the research for the inclusive solar finance framework, we and the team at Sustainable Capital Advisors found the 5 types of interventions that our interviewees identified the most. So first, refundable tax credits. So making the ITC and any state tax credits refundable allows low-income customers to receive the full value of those incentives without having to utilize like a multi-year carry forward to offset future taxable income. Under reprogramming existing energy funds, here we say that, identifying existing financial resources that can be reprogrammed to meet the needs of low-income customers can create significant flexibility to support grants, credit enhancements, and other strategies to expand access. So for example, the Department of Energy recently authorized Colorado and its Colorado Energy Office to be the first state in the nation to integrate rooftop solar into its weatherization assistance program. CEO moved forward in 2017 with a pilot leveraging of eligible weatherization assistance program funding and matching incentives with the utility, and comprehensively is addressing the energy burden of about 300 low-income households. And they're finding that the addition of solar onto weatherization is doubling the consumer savings that their customers are seeing. Under credit enhancement, governments, foundations, investors, and others can be really valuable in providing long-term credit support for low-income, low credit score customers. So this could take the form of a loan loss or first loss reserve, interest rate buy downs, guarantees or insurance. And then alternative credit scoring is something that a lot of folks are very interested in. Using alternative credit scoring methods expand the data points available to evaluate credit and should provide more access to solar finance products. So expanded data points could be like utility bill payment history, telephone bill payment history, and others. And then finally, community solar was something that was very, very popular as an intervention among our interview partners. The community solar subscription model is both a consumer access method and an intervention, because this method provides policy and market opportunities to significantly expand access and opportunities for low-income and low credit score customers, as long as there are certain key program design elements included, such as creating a standby purchaser or allowing for large anchor tenants to participate in a project. Also creating a bank for net metering credits and making sure that subscriber updates can be made on a timely basis. I'll note too that our analysis of these potential interventions assumes that there's a basic policy environment in place that might include renewable portfolio standards with a solar carve-out, net metering, and some sort of remote net metering. Next slide. And if you want to click a few more times, that would be great. the interviews that Sustainable Capital Advisors did for the Inclusive Solar Finance Framework provided context to not only historical concerns and barriers, but also to how the interventions will need to be structured to meet the needs of our target customers. So these observations provide a reminder that while the intentions behind some prospective interventions are well-meaning and positive, it's important to be mindful of the potential for unintended consequences. For the next few slides, I'll go pretty quickly, but I wanted to provide a few examples of some states that are operating in a way to make financing products more accessible. So on the next slide, I included just a graphic about the Mass Solar Loan. So in Massachusetts, the Clean Energy Center has partnered with the Department of Energy Resources to create the Mass Solar Loan Program. And this is a program that provides interest rate buy-downs, income-based loan support, and a loan loss reserve. And so this program has been around for several years, but it's been so successful, the market has taken off in Massachusetts, that a couple of years ago, the Massachusetts CEC actually said, hey, we're going to reserve this program now just for low-income customers. So the last time I checked, there were several thousand low-income customers who had been able to take advantage of this program. Next. Here, I just wanted to highlight something new that I'm pretty excited about in terms of its potential. In Hawaii, the GEMS program has been around for a little while, but recently Hawaii announced that they were introducing a new OnBill tariffing program. And through this OnBill tariffing program, all customers in the state, including renters, can use OnBill financing to pay for energy improvements like energy efficiency and also solar. So because of a few key components of this program, we're excited about the potential for this program really to open up access to financing and then also to those clean energy improvements. So importantly here, an important component of this is that the financing arrangement is attached to the customer's meter, so that if the customer moves, the next customer who comes and uses the property and the meter takes on the obligation to pay for the energy improvement, but they're structured in such a way that the payment is actually less than the energy savings. Next slide. On the next slide, yes, we'll see this is an example of the PACE program being used very, very well. This is the DC PACE program, and for this particular project, they were able to integrate $700,000 of approved PACE financing into a $17 million capital stack with 8 other sources of capital. This is the first, I believe, use of PACE financing for a U.S. HUD-assisted mixed finance public housing property. And the improvements are expected to reduce energy use by 24% and water use by 47%. Next slide. Really quickly, this is an exciting example of a community solar project where the Michigan Community Action Agency and the Michigan Agency for Energy partnered with a local rural electric cooperative to use some grant funding, incorporate LIHEAP funding for energy efficiency improvements, and be able to deliver the benefits of community solar and energy efficiency to customers. And they're targeting about $350 a year for savings for each customer. And then finally, next slide. I shouldn't say finally. Also, again, wanted to highlight the Connecticut Green Bank. They have created a suite of programs for expanding solar and other clean energy investments for underserved communities. And as I mentioned earlier, under their Solar for All program, in partnership with Posigen, they use energy efficiency in addition to solar, and they are targeting $500 of annual savings per customer per year. So again, through this program, they have managed to reach over 2,000 low-income families, and they're also achieving racial equity in solar deployment. On the next slide, I think there are some really interesting thoughts shared by the Connecticut Green Bank, talking about having a long horizon, analyzing the market. Don't assume that low and moderate income residents don't want solar, and also don't assume that low income residents are also low credit residents. The Connecticut Green Bank actually found that many of their low income customers had decent credit. And there are some other interesting lessons learned here that I wanted to be sure to share with you. Why don't we skip ahead a couple of slides? Yeah, skip one more. Wanted to let you know that, that's fine. In the previous slide, there was a graphic of our low-income solar policy guide. Wanted to highlight that for you as a resource. This is a guide that we developed in partnership with Grid Alternatives and is a toolkit and a menu of different policy options that we're seeing being successful around the country for deployment of solar for low-income customers. And the last slide is just my contact information. So I will stop and thank you all for your time and the opportunity to talk today.
All right, I think it's over to me then. Should I just go right ahead?
Sure, go ahead, Bettina. Thanks.
Okay, great. Hi, everyone. This is Bettina speaking, and Burgu. I'm from the NRDC's Green Finance Center. Like Melanie, just want to say thank you for the chance to talk to you guys today. I know that it'll be mostly me and Melanie sharing information, but I'm sure there's lots of exciting stuff going on in y'all's home offices that I'd love to hear about today or another day. And I also will give my email address at the end. So I am going to shift gears a little bit and talk about specifically energy efficiency, shifting from solar, and specifically energy efficiency in affordable multifamily housing. So just to be clear, this is subsidized as well as unsubsidized multifamily housing. And I think we can go actually just past the agenda on the next slide, and I'll just dive right in the interest of time. So I know that for those of you on this call, I don't need to go over the basics of energy efficiency. I think everyone here is pretty on board with efficiency in solar in concept, but I do like the way that this visual shows the benefits of energy efficiency specifically for rental housing. The key actors involved are tenants, property owners, as well as the property owners, lenders, and investors. So I will let you guys take a look at this in more detail if you want another time, but for right now, I'm just going to zero in on the financial stability portion of this visual. If we go to the next slide. So we're talking about affordable multifamily housing. One driver of energy efficiency in affordable multifamily is that it can increase net operating income. So this might be a concept that many of you are familiar with, but for those of you who aren't, net operating income, or NOI, is a really important figure in the affordable multifamily housing space. It equals income minus expenses. So Sam, if you could just click. Yeah, you can see here a cash flow analysis of a real building, actually, in Connecticut, a 22-unit multifamily property. And this cash flow analysis shows that the net operating income is calculated by taking the total income minus the total expenses. So if we want to increase net operating income, which most property owners do, I would say all, then there are only a few ways to go about doing that. You can increase income or you can reduce your expenses. And I just want to take one step back actually and review why NOI is important for those of you who aren't very familiar with it. NOI, as you can see here, is used to make debt payments and pay investors. It is the kind of operating income that you can use to make property improvements. And it's also really important because it is a figure that lenders will use when determining how big of a loan a property can support. And it can also be used in calculating property value. So for all these reasons, a higher net operating income is a really good thing. And for affordable housing owners, as you can imagine, there are only so many ways of increasing income, the main one of which would be raising rent. And for affordable housing owners, this is something that maybe they don't want to do or they can't do because of rent regulations. So then if you look down at the expenses, you can see that there's taxes, there's insurance and legal fees. Most of these are not very easy to change. So at this point, you probably know where I'm going with this. We've got taxes as the by percentage largest expense out of effective gross as a percentage of effective gross income. And the second largest one is utilities. So if you want to click one more time, I think, Sam. Yeah, so utilities there. The magical thing about utilities and affordable multifamily is that it is not only often a very large operating expense, but it is the largest controllable operating expense. So by reducing utilities, this is a major opportunity to reduce expenses, which, as you can see here, increases net operating income, and that is why it will make a property more financially stable, amongst lots of other things. But I think we'll stop there and we'll move on to the next slide. So we have established that there's good reason to look at reducing utility consumption, but of course there are barriers to doing so. I wrote about these barriers in a paper that I did for the Green Bank Network last year. So the full title and cover page is here if you want to check out that report. I summarized the barriers to financing efficiency in affordable multifamily with 4 C's. They are capacity, cognizance, confidence, and capital. So capacity refers to essentially limited staff time. Cognizance refers to limited awareness of efficiency technologies. Confidence refers to limited exposure or maybe skepticism about how reliable efficiency projects are. And capital refers to the lack of capital reserves or affordable financing options if they're necessary. So let's go to the next slide. So I work on a team called an initiative called Energy Efficiency for All. EFA was established 6 years ago to address exactly these barriers and increase efficiency in affordable multifamily housing to make housing more affordable and healthy in the long term. So we are operating in 13 states, and you can see them here on the map. If you are in one of these states and you're not familiar, connected with the local EFA coalition, I would love to make that connection for you. On the national level, we have 4 core partners bringing together the housing and the energy efficiency advocacy worlds. So you can see those on the screen here. And I will go to the next slide. Let's see here. All right, so I will not go into detail on what all of EFA does. Those of you who are familiar, perhaps the folks in New York, know that the EFA advocates do a lot throughout the 13 states. We advocate for policies that are really foundational to efficiency in multifamily, things like building codes and energy use disclosure policies. And we also advocate for programs that effectively drive resources into multifamily efficiency projects. And those programs really are meant to address those 4 C's that I mentioned: capacity, cognizance, confidence, and capital. And while I will kind of move on quickly to our financing efforts, I do want to just mention one of the most important things that EFA does advocate for, which is the delivery of efficiency programs through what we call the one-stop shop service model. So through this one-stop shop model, a property owner, so a customer, let's say, will get one point of contact that will work with that property owner from the beginning of the project to the end of a project. And there are other things that are involved in that model. You can check out the fact sheet, or we can touch base at another time to talk more about it. But what I want to say before moving on to financing approaches is that, there are a lot of utility programs out there. As you guys know, some of them provide more comprehensive financial and technical support than other ones do. There are some programs that provide a lot of financial support for projects. The low-income weatherization program in California, for example, gives incentives that cover pretty much all of the projects, so 80%, sometimes 100% of a project, and that is fantastic. That is absolutely warranted and what we want to see. So again, the advocates are hard at work getting those programs in place, but we also know that sometimes incentives don't cover that much of the project. Sometimes the program only covers 10 or 20% of the project cost. So that is when it may be necessary for affordable financing to be in place if there aren't property reserves, financial reserves to cover the cost. So my goal within the EFA team is to promote the combination of this funding in the form of incentives and rebates with financing to get financial packages that support more upgrades and deeper upgrades. So let's dive in to the next slide, which really gets into the financing. So thank you. So to understand kind of the way that I've set up the two approaches to financing efficiency that I'll go through, it is important to know a couple pieces of housing development lingo. So rental housing is built with a construction loan, and then that turns into a permanent loan, i.e. a mortgage. And then after that, for the life of the property, that property's mortgage will be refinanced generally every 10 or 15 years. And all the rest of the time in the property's life cycle, when it is between these refinance events, it is called mid-cycle. So you have properties that are at refinance, and you have properties that are, quote, mid-cycle. So the first approach that I have here is integrating efficiency into these refinancing events. The reason I put this first, and I'm really excited about it, is that the time of refinance is really critical for multifamily property owners. It is a time when the financing arrangement for a property, which are often very complicated, are kind of up for negotiation. All the money is on the table, and it's one of the few times when there's access to sufficient funds to cover major capital improvements. Things like the HVAC system that are throughout the entire property, as opposed to maybe in individual units. So we see refinancing as a major opportunity to get energy efficiency upgrades into the scope of work that will be covered by the refinanced mortgage. And this is perhaps primarily because this mortgage capital is the lowest cost, the longest term capital that you can come by. And also, by integrating the financing for efficiency into the mortgage, you remove the need for another lender to be involved and another loan product to be in the mix, and that just further complicates things. And in this sector, we really just want to keep it as simple as possible. All right. Sorry, my computer fell asleep, of course. All right, well, I'll deal with that and kind of keep talking, assuming we're still on approach one. So the great thing is a lot of affordable housing lenders are already integrating efficiency into refinancing. I have to mention Fannie Mae as a driver of the green mortgage market. They have done a lot to drive green mortgages. As you may know, they have issued over $50 billion in green mortgage-backed securities, but there are also a lot of other players involved, from big banks to smaller banks, small, regional and local banks that are working on integrating efficiency into their mortgage processes. So I have some best practices listed for properties that are at refinance. One is, which may be obvious, just have more lenders integrate efficiency into their standard mortgage lending process. This is something that the Community Preservation Corporation in New York has done, along with others, but they are the author of the Underwriting Efficiency Handbook that you see here on the left. I'm working with the Community Preservation Corporation now to take this handbook across the country, share CPC's experience, and get more lenders integrating efficiency into their lending processes. The next best practice is related to partnership. The Community Investment Corporation is a housing lender based in Chicago, and they are another lender that has integrated efficiency into its mortgage lending process, but it has also partnered with Elevate Energy, which is a technical assistance provider, and Elevate Energy brings property owners to CIC. They identify opportunities. They will really do a lot of hand-holding from start to finish, from audits through to measurement and verification of savings. And that has been really helpful in driving uptake of the Community Investment Corporation Green Mortgage Program. So definitely a best practice, if that's possible. And then the third best practice listed is commitment letters. Oh, okay. Yeah, this one's related to the delivery of incentives. If a utility program says that I will, probably reimburse you in part or in full for doing an efficiency upgrade, then a lender that's considering financing that project isn't going to be able to include that funding source as a real funding source in putting together a financing package for an efficiency project. It's just not real enough as a committed source. But if the program administrator sends a letter of commitment for X dollars for this project, then a lender can actually take those incentives and put them into the capital stack for a project. And of course, with the lower total finance, the low total cost and need of financing, that will make more projects pencil out financially. So this is hugely useful, even if it's pretty simple. And this is something that the housing lender LISC that I have listed has had success with in Massachusetts. So let's go on. Sam, are we on the approach 2?
Yes, we are.
Okay. Okay, I got it back on my screen as well. I'll have to move around the mouse a little bit. So moving on, as I said, mortgages, I'm particularly excited about this integrating of efficiency into refinance. But as I said, mortgages tend to only be refinanced every 10 to 15 years. And given all the crises, climate and affordable housing, we know that we just can't wait 15 years to serve all multifamily properties. So it is still really important that there are mid-cycle efficiency financing options available. So mid-cycle properties are, again, I think I mentioned, they are characterized by low cash flow. They have limited capital reserves. And one thing that's really important to remember is that they often have limited ability to take on debt, especially secured debt. That is usually just like a no-go. So one promising mid-cycle product is the unsecured loan specifically for efficiency upgrades. I'm not going to mention the specific logos that I have here. There are folks who do offer these things, so happy to answer questions about them later. But one thing I just want to say about unsecured efficiency loans is that it's especially helpful if the loan can cover health and safety work. In some cases, an efficiency project cannot move forward if there is, for example, lead or asbestos remediation that needs to happen. And if there's an efficiency financing product, but it can't cover health and safety work, at least to some extent, then that means that a lot of projects that are maybe properties that have a lot of deferred maintenance that really need an efficiency upgrade and could benefit from it the most will not move forward. So it's really helpful when those unsecured loans cover health and safety measures. Another promising product that I think maybe Melanie mentioned and probably y'all are familiar with is the Energy Services Agreement. This is when an energy services company installs the upgrade with no upfront cost to the property owner, and then the energy services company repays the loan that they get through the financial savings that are realized from the efficiency project. And we have seen ESAs in the multifamily sector, both on the property level, which is more common, but also on the portfolio level. So that means that there's an ESA that covers not just one property, but a whole bunch of properties. And that is one way to diversify the risk of just one property, or just one project, I should say. And then we also have a couple things that Melanie also mentioned for solar, PACE, and OnBill repayments definitely have potential to fund efficiency in affordable multifamily housing. IFA commissioned a study on the applicability of PACE to affordable multifamily, and you can find that on our website if you're interested, or we can talk about it later. And definitely potential for on-bill repayment, either loan or tariff-based, but there is a ongoing dialogue amongst advocates as to how those can sufficiently protect tenants, and that's a really interesting conversation. Okay, so in getting toward the end here, the next slide. One last kind of substantive thing I want to mention is I just think I would be remiss if I didn't mention underwriting efficiency. This is an approach to financing efficiency that is applicable both during refinance and mid-cycle. And I really like this illustration from the CPC's Underwriting Efficiency Handbook. You can see that using the top line, that's using traditional underwriting, a lender would use past income and expenses to calculate a property's net operating income. And then, as we talked about earlier, that would be used to calculate the supportable loan. But if you look at line B, this is a savvy lender to a property that's undergoing an efficiency upgrade. They are actually acknowledging that in the future, utility expenses are going to be lower, and that increases net operating income, and that unlocks additional loan proceeds. So one reason why this is important and really impactful is that means that more of the costs of an efficiency project can be covered by that loan, and then less, if any, of a financing gap remains to be filled with incentives and subsidies. And we know how valuable those are, and we want to make them go as far as possible. All right, and in my last slide, which you can go to, is just to say that much of the work that I do to promote all of these financing approaches through Energy Efficiency for All is through the Sustainability and Affordable Housing Lender Learning Network, or SALN. So this is a knowledge exchange platform for lenders that either are financing efficiency or would like to. We have lender exchange calls and an online website with a resource hub and a couple databases. Recently, we formed it was actually earlier this year, we formed a climate resilience finance working group, and we released a discussion brief on managing climate risks. So you're welcome to check that out on our website as well. So if there are any lenders on the line or just folks who are allies, then you're more than welcome to sign up for our mailing list on the website there, or we can just talk otherwise. So that is it, and I look forward to the conversation.
Great, thanks so much. So I think we've got time for a few questions from the audience. So if you have any questions, please be sure to enter them in the chat box, or please raise your hand so we can unmute you and we can and make sure that everyone can get a chance to answer.
Hey, Sam, this is Dan. I could jump in with a question while folks are typing for our speakers. Yeah. Well, wanted to see in terms of multifamily, since we just came off of Bettina's presentation on that, there are, as Bettina alluded to, a number of additional challenges in terms of financing because of the complexity of the capital stack and financial arrangements that are underlying our affordable housing developments. But I'm wondering if you can comment a little bit more on what you're seeing as best practices for encouraging better coordination between housing agencies, state energy offices, capital providers, and other providers so that multifamily properties can more easily finance the efficiency or solar improvements that they need to do in a timely fashion.
Mm-hmm. Sure. Yeah, I'd be happy to start that, and I don't know if it's possible to open the line or if it's just kind of us panelists speaking. But I would say, I mean, there are a number of states that are doing this well and really are trying to coordinate all the different actors. New York certainly, NYSERDA is doing a lot to coordinate. And the places that I mentioned, Chicago, Boston, and California, are certainly taking steps to coordinate actors because, as you said, things are complicated enough, and owners are really not looking to talk to more people than they have to. The one place that I would mention that hasn't been brought up yet, I would say, is Minnesota. I have really enjoyed working with the Minnesota Housing Finance Agency called Minnesota Housing. They have been a leader in financing efficiency in their own portfolio, but something that they've done that's really simple but kind of has opened up a lot of doors is that they actually put together a Word document that has a side-by-side timeline of how to concurrently access the HFA financing process while accessing utility program incentives. So it just really shows what steps need to be taken at the same time and in what order in order for all of those funding streams to come together. And that's been a really great thing for Minnesota Housing to take the lead on doing. And now I'm working with them to get lenders together from across the state to talk about financing efficiency, and we're working with the government on that as well. And then I would also say, I was going to add Connecticut, but I think Melanie gave the shout out to Connecticut Green Bank as well. They have been really instrumental in that state to bring everybody together.
Bettina, hi, it's Jeff Pitkin. I wonder if I get a quick question in. As you know, we're working for energy efficiency for all and trying to unleash and crack the nut that is the challenge that is, addressing affordable multifamily. And, the approaching refinancings of buildings is incredibly complicated. And whether it's the work that you're trying to do through a housing finance agency, or the way in which underwriting occurs, or the mortgage, the insurance, and I know you alluded to more often than not refinancing is an opportune time. In your opinion, though, what is it that causes the inability for the kind of mid-cycle financing to not be more prevalent? Because, of course, that mid-cycle may be, if you structure it with the right tools, could be an opportunity to avoid the complicated capital stack that exists at the time that you refi a building. And so, in your opinion, what is it that isn't causing more mid-cycle financings to occur?
Yeah. Well, I do think that, the ESAs, I don't want to say that they're new, but there are an emerging number of mid-cycle financing products that are kind of gaining steam and that folks are getting more aware of. So maybe there's, so I definitely don't think that there's not opportunity mid-cycle, especially given unsecured products. I think maybe for a while there were a lot of secured products that were out there, and there was kind of a question mark as to why they weren't being used. And now we know that secured products just are not very helpful given complicated financing arrangements. And so that's good and kind of shows that we're making progress on mid-cycle financing needs and meeting them. But I would really say, what is the barrier? I would go back to the 4 C's, or maybe 3 of the C's: capacity, cognizance, and confidence. I mean, first of all, capacity. I think I could even just end there. I think just time and competing priorities. If you don't have to do something on top of your list of 1,000 things, probably you're not going to pursue it. Maybe you will if somebody has a very attractive proposition that they approach you with, specific to your property. But then even if someone makes time, then the confidence factor is real. Folks not being quite sure whether the projected savings are going to be realized. And for that reason, I think it's interesting to see more mid-cycle financing products that have like savings guarantees, right? Like some ESAs have savings guarantees so that property owners are not taking on the risk of savings not materializing. But yeah, I think the 3 C's, I would go back to that. What do you think? I'm interested to know.
No, I get it, and don't disagree. It may be, on the part of the building owners, just, the not wanting to undertake the brain drain during a time frame when you don't have to do that. And so maybe it's a more opportune time at refinancing of a building to take those opportunities into consideration. Just wonder if there's an opportunity then for, addressing some of those confidence factors. And so whether that's work that a state energy office could do or a green bank could do to provide some form of credit enhancement or confidence builder in the marketplace, right? That would help to better encourage the building owners to undertake those mid-cycle opportunities.
Yeah, I don't want to monopolize the time here on the line, but I'll just respond by saying, I think, yes, there is opportunity to educate property owners. I think that's a lot of what has happened to date is get property owners aware of efficiency. But something that the track that I'm pursuing more is leveraging lenders as communicators about efficiency because they are already talking to their borrowers. And I think that state energy offices could, in addition to supporting outreach efforts to property owners, could also support lenders becoming more confident in efficiency and seeing it as something that they do want to talk to their borrowers about.
Great, thanks.
So we have a question here for Melanie. And Melanie, have you found a difference in the uptake of financing programs between the low-income segment versus the moderate-income segment? My experience of working with LMI communities is that financing programs are often not the best solution for those who are really low income because they're in survival mode, trying to figure out how to pay rent and put food on the table, and thinking of financing a solar project is not at the top of their mind.
I think that's a really important consideration. So what comes to mind is the Mass Solar Loan Program, for example. The Massachusetts Clean Energy Center has found that many of the consumers who are taking advantage of that loan program, which now is solely accessible for low-income customers, are actually senior citizens. And so, that's a particular type of customer, that might be on limited income, but really in other aspects of their life are pretty stable. And so, they do have that stability available. I think back to a process and some advice that I've seen from the Connecticut Green Bank, where Connecticut started from a posture of doing deep market analysis to understand the customer segments in their market. And they designed different types of programs to reach different types of customers. So I absolutely agree that I don't think there's one size fits all here across low and moderate income customers. To the extent that state energy offices have the ability to do some market research and some market segmentation, I think that will help you figuring out the different types of offerings that can be most beneficial for different types of customers.
Great. So I think we are actually out of time now. Jeff or Dan, if you'd like to close us out, that would be great.
Absolutely. Thank you, Melanie and Bettina, for your presentations. A lot of information, a lot of helpful information. We really appreciate it. Thanks to everyone that tuned in today. If NASEO members would like to suggest additional topics for this group to cover, please reach out to Sam at NASEO. And also wanted to let you know that NASEO staff are ready and willing and able to talk with you if you have specific questions about standing up a program on energy financing. So please feel to reach out to them as a resource. And with that, I think we'll adjourn the call. Thanks, everybody.
All right, thanks so much. Y'all have a good day.
Thanks for having us.
Bye.
Bye-bye.
Thank you.
All right, thanks, everybody. Have a great afternoon. Bye.